also a certified community bank risk specialist, and I'm excited to be your host today. This program is brought to you by Bankers Bank, the Midwest's leading provider of correspondent banking services to community banks. As an independent source of non-competing financial services, Bankers Bank serves a market of over 600 financial institutions and provides a strong portfolio of innovative solutions to help your local community banks thrive and focus on the needs of your customers and your communities. Our risk topic today is navigating commercial risk in 2025. Before we get started, I'd like to cover a few logistics. Due to the number of attendees, your phone lines and speakers have been muted. Please submit any questions you have via the chat box, and we'll get to as many as we can at the conclusion of the presentation. We're recording this webinar and we'll share a copy of it along with the slides to all attendees. You'll also be directed to a short survey at the end of the webinar. If you would, please complete it and share your ideas for any future webinar topics. Joining me today is Matt Ladio, the Chief Commercial Banking Officer of Bankers Bank. He's been with Bankers Bank for 8 years and is located in our Madison, Wisconsin headquarters. Also joining me is Jim Cluck, who's a member of our Risk Management Solutions team. He's been with Bankers Bank for 9 years and leads our ALM solution offering called ALM Driver and is located in our Madison, Wisconsin office as well. For our agenda today, Mr. Ladio is going to go over commercial trends in the Midwest for our first half. In the second part, Mr. Cluck will review credit and risk modeling using ALM. And so at this point, I'd like to introduce Mr. Ladio and have him take it from here.
Morning, David. First, I'd like to thank you for letting me be a part of today's webinar. Also like to thank all those in attendance. Appreciate you joining us today. As mentioned, I'm Matt Ladio, Chief Commercial Banking Officer at Bankers Bank. I've been in banking for about 30 years in various roles and 8 years here at Bankers Bank. Also a CPA. But I don't mention that as often in the banking world. So let's get started here. We'll talk about commercial trends in the Midwest and the 2025 outlook. Going to spend a little time talking about the trends we're seeing in the Midwest halfway through the year, particularly Wisconsin, Iowa, Illinois, Indiana, Ohio, and Michigan. I want to start off by saying that we built this deck about a week ago, and I think as we all know and have experienced with the uncertainty and speed of change in our industry, what may have been true at 8 a.m. this morning could have possibly radically shifted by the start of this meeting and could change 2 more times by the end of the day. I'll cite some sources throughout, as well as sharing what we're seeing and hearing here at Bankers Bank as well. So for the agenda, today's discussion, we'll be digging in a little bit on net interest margin or NIM compression, loan demand dynamics, agricultural lending conditions, some state-by-state trends we're seeing, and some strategy to those items. So macroeconomic conditions. Looking back a little bit to 2024 quickly, as we all know, the yield curve uninverted at the end of 24. Rates did slightly decline, but still remain elevated looking back historically. Labor was cooling and inflation was easing, but as the word was, it was still sticky. A quick look at 2025 to date. The forecast GDP is between 1.4% and 1.7%, depending on who you're talking with. Recession odds are in the 35 to 40%, and we still continue to have geopolitical risks. On the good side, we're seeing deposit growth for the first time since 2021. So the first item on the agenda, net interest margin compression. 2024 NIM pressures was a combination of 2 things. One, loan yield rates falling faster than the cost of deposits. The deposit betas are the measure of how much a bank's deposit rate changes in response to the changes in Fed fund rate, was up to about 32.9%. Normally it's in the 20 to 30% range. And then on the other side of that, the loan beta only increased at a pace of about 28.6. And historically that could be as high as double that. One area where we did see a particular faster falling yield was in the C&I, where the pricing fell on that earning asset compared to the deposits. And part of that, we believe, is banks were going after that type of customer in the community banking world because they typically come with better deposits than some of the CRE. So kind of some of the NIM recovery that we're looking for and going to see probably in the second half of 2025. Again, this is not across the board. We're in the 6 states that I mentioned, and markets are different, locations are different. But kind of what we're seeing is there is some slowing in the deposit competition world. We are seeing loan demand starting to pick up. But I would say what we're hearing and what we're seeing, it's at a slower or a softer pace than I think was put into budgets and forecasts for 2025. So that's probably going to impact second half earnings, possibly. Might be a little softer than the first half of 2025. And again, probably one of the bigger things that we're seeing and looking at and hearing is the repricing of those 5-year loans that we all originated in 2020 at those 3.25, 3.75, 4.25 rates. And part of that is going to be to retain those customers. If you can pick up the 250 to the 300 spread, that'd be great. But if you don't do anything and you just let them roll off, then your NIM won't improve. So we'll dig a little bit in here on loan demand. We'll look at C&I first. So the Senior Loan Officer Opinion Survey as of April 25, they saw a weaker C&I loan demand across all the different business sizes. Even CRE tied to the C&I, so the owner occupied, has been weaker as well. The banks have reported tightening policies and procedures, the procedures to tighten the policies. When it comes to loan to value ratios, debt service coverage ratios, and tightening up or shortening interest only periods. We're seeing this with participation opportunities that we see as well. On the positive side, though, however, charge-offs continue to remain low at this point. We do see a few one-offs here and there, kind of loan specific. Loan demand on the consumer side, just wanted to touch upon this briefly. Again, the April 25 Senior Loan Officer report, residential loan demand remains weak while HELOC demand is strengthening. Again, in specific markets, I was in Waukee, Iowa 2 weekends ago, and the residential building there is just booming. Madison as well, the housing market, while softened and days on market have ticked up a little bit, it still seems to be a pretty good demand. Consumer demand in general feels like it's weakening a little bit, especially for credit cards. However, lending standards are mostly unchanged, and again, maybe tightened a little bit for higher risk segments. So CRE lending risks that we're seeing, typically one of the biggest buckets that we have in community banking. Again, a little trickier in the Midwest, the old cliche of location, location, location. As I mentioned, Madison and Waukee, there's other areas that maybe are a little slower. But again, some of the areas that I go through and visit with do have some pretty good growth. I was once told by an old banker, you could tell how the market is by the number of cranes that you can count in the skyline. Quite a few cranes in the Waukee and heavy equipment, as well as some other areas in Madison. In general, CRE, from what we see, will remain under pressure and scrutiny, especially in the office space and the construction space. We do see top tier properties appear to continue to remain stable. I jumped around there real quick. Charge-offs are still low, but again, there are a few one-offs, as I've mentioned. And again, construction and development loans are going to be closely watched. Refinance risks do exist. So, strategically, as we all know, the regulators love and appreciate to see stress testing in every segment, but especially commercial real estate, not only on an individual credit basis, but a portfolio wide. The questions are, can the borrower with the refi, can they cash flow 200 or 300 basis points higher? We heard a lot of, will it need to be a cash in refi? Maybe the community bank, maybe, you're willing to take a little lower rate to make it work and keep it. We are seeing a lot more questions and options with off-balance sheet avenues, such as agency lending with Freddie, Fannie, and HUD as it relates to housing. We're getting a lot more calls and questions on how agency works, what are the options. So in that refi piece, and this was related to sub debt, another thing that's going to kind of come into consideration from a holistic standpoint at the bank. That 5 year, so when you do the sub debt, most of them are 10 years, 5-year fixed, and then 5-year with a variable option. And we're getting a lot of questions with that as well. We just reissued for a bank $16 million sub debt at 7.5. It was going to be north of 8% on the variable rate. Another one of our customers had about the same amount, about 15 million in sub debt. They wanted to have the option to pay it off a little more aggressively. So we've worked some senior debt options in there with lines of credit, short term, and then we can roll it into a more fixed rate, long term amortizing. So those are some of the things that we're helping our banks with. Again, work with your borrowers, help them to understand that changes are likely. Again, as I mentioned, there's a lot of movement in the markets and kind of where rates are. And when we look at the treasuries, the 5 and the 10, the 5-year curve they're kind of where we're at today. So I don't know that we're really anticipating rates to get back to the 3.25, the 3.5, 4.25 days. And I think borrowers are still holding on to that a little bit. So, as we can educate them, I think it'll make it easier on the CRE side, especially. Some small business lending trends. Again, we're in that business. Community banks do a lot of small business lending. What we're kind of seeing and hearing, higher input costs, tighter labor. You got to keep an eye on the support from the consumer spending within your individual markets. The concern is slower spending equals lower earnings. And the confidence index at the beginning of the year was on a 5-month decline, but it did tick up a little bit in May, so that was some positive news there. Agricultural lending, as we have seen, ag conditions did soften in 2024, the second straight year, and we're kind of hearing and anticipating that it will continue to soften in 2025. Corn and soybean losses are projected for 25. Loan quality is modestly deteriorating. Some liquidity is tightening, not only at some ag banks, but also for the ag borrowers. So, farmers are looking at, leveraging up the land a little bit to carry them through this. Outside factors that come into play: tariffs, drought, flooding, again, weak prices. This might be a time to revisit insurance levels that the farmers are carrying. I was at the CBI in Iowa last week and talking to some bankers, and One of the bankers had a farmer that had some hail, wind damage, and the corn got blown over flat, and he had some people come out and look at it, and he said the positive thing for the farmer was that it did germinate, so they're going to spray it and try to save it and pick it up off the ground. So, rather than scrap it, they're looking for alternative ways to get as much out of the crop for the yields this year as they can. Again, regulators love stress testing ag loans. What I hear is they love frequent farm visits and quick action to any rising delinquencies in the portfolio. A little bit on some regional trends that we're seeing: Wisconsin, Iowa, and Illinois. In general, Wisconsin and Iowa, stable community bank lending, but keeping an eye on ag exposure. In Illinois, there's some CRE pressure in the urban areas, and they're starting to see that loan demand lagging a little quicker from what we're seeing and hearing. Again, net interest margins will probably stay flat across the community banks. Top CRE is stable, but there is some stressing emerging. As I mentioned, location. So that's kind of the Wisconsin, Iowa, and Illinois high level. Indiana, Ohio, Michigan trends that we're starting to see again. From what we're seeing and hearing, Indiana and Ohio are showing some good deposit growth. However, what we're hearing and seeing is a little bit more of a focus on cost control there. Michigan is seeing higher CRE vacancies, and they're starting to see a little bit of loan growth slow as well. Again, margins flat across location, as far as trends that we're seeing there. Strategic themes for the Midwest. I think, it's going to be key to manage repricing risk. Keep an eye on where cost of funds and deposits are. We are seeing, for the most part, community banks and in deals that we see in discussions that while some banks and lenders are getting defensive on loan pricing, they're really trying to stick to their rates that they need in order to get the margin. And hearing from time to time that one or two of those deals are walking out the door, or they've made the decision that it's too thin. There's no deposit support, so they're letting that leave. Again, we need to maintain credit discipline in CRE and ag, as that may continue to stress a little bit. Focus on operational efficiency to preserve earnings where we can. And I mean, without saying, seek as many low-cost core deposits as you can. A little bit on M&A as I kind of get close to wrapping up here, and capital planning as well. Again, I talked a little bit about the sub-debt reset risk. If you let it roll in a variable portion on the second half of those 5 years, those are in the 8s or a little higher sometimes. If you reissue it, clearly you'll have a higher interest expense, as fixed rates are higher than they were back in 2020. If you don't reissue or you pay it off, you got capital considerations there. So we're getting a mix of both, as I mentioned. Getting a lot of inquiries on us helping banks to either reissue or convert to senior debt. And as I said, the ability to offer that is something that we look forward to have discussions about. On the M&A side, we clearly expect to see that pick up in the second half of 2025. I think a couple factors. What we're again hearing and seeing is there's confidence that regulatory approvals will come faster and quicker. And we just had one announced in Wisconsin, a merger and acquisition of two banks, two multi-billion-dollar banks. One's purchasing the other, expanding their footprint into the South. But we're going to get more and more of those. We're going to hear more and more of those. We're getting more and more questions on what terms would look like. We're getting more and more opportunities to offer term sheets, probably, quite half a dozen or so. And again, that has picked up from our standpoint as well. So kind of in closing and summary on the commercial credit risk side before we turn it over to Jim and modeling. Again, 2024 showed resilience, but we started to see headwinds that have built into 2025. We need to keep additional focus on CRE and the ag sectors. Jim will talk a little bit about being strategic in the ALM management side. Local knowledge on the markets and your individual borrowers. That's clearly the differentiator with your portfolio compared to others or larger institutions. Again, that community bank, personalized touch. Banking 101, banks that adapt to the economic structural shifts will lead and win. One of the other things that kind of has come up here recently is the ACRE, the Access to Credit for our Rural Community Economic Act. We're keeping an eye on that as well and see how that might impact community banking. So those are some important kind of wrapping it all up together. Some of the sources I pulled this from, we pulled some of the quarterly FDIC, SBA surveys, some Kansas Fed, Bloomberg, Market Watch, and just our discussions with our community bank partners. So now I'm going to turn it over to Jim. Jim's going to discuss modeling, risk modeling today. And so, Jim, it's all yours.
Thanks very much, Matt. So from the introduction standpoint, if you recall, I've been within banking for the past 30 years, and specifically with asset liability and modeling, probably for the past 9 years. And here at Bankers Bank in our program, the ALM Driver Tool. Now, I want to assure you, when you saw the topic of credit and modeling, you're thinking, oh, great, are we going to get into standard deviations and down to the 10th decimal place in this discussion? I want to assure you that's not going to happen. Really, what I want to talk about is a very high level look, first of all, at the credit risk side and how that can manifest itself within the modeling. And just it's from an awareness standpoint. And then circling back to something that Mr. Ladio referred to, which is strategic modeling, right? That's a great term, but what does that really kind of mean to us and how can we think about that? So thinking back to the presentation that you just saw, there was a lot of terms in there, right? So everything from change in the macro level to how you responded. I think the number tossed out there was betas were up, on the deposit side, 32.9%. And so there's a lot of different directions, a lot of different dynamics going on. So, one question that we can ask ourselves is how realistic is it? How can we see where credit is kind of incorporating into that overall big picture? And can we see it from a modeling standpoint? And then is it realistic to think that with our limited time that we have available, and you all probably the least thing that you have available to you is time, can we realistically try to address all the topics that you see up here with a model without being buried in minutia or trying to deal with analyzing 20 different scenarios? Is that what modeling looks like? So, that's what I wanted to address. And first, we're going to really start with that credit risk and how all that is connected. So with risk, it is connected, right? Just like your bank, and there's a lot of different dynamics involved. Your net interest margin ties directly into the risk levels. Your credit risk is not disconnected from your liquidity risk or your interest rate risk. They are all connected together within reality. Now, when it comes to the lending side, and most of the individuals participating in this call have the lending background, you definitely take a look specifically at that risk profile of that lending book. You take a look at it from the standpoint of segmentations and looking at concentrations. Um, uh, as Matt indicated, taking a look at some stressing there, maybe increasing your default rates or changing collateral values and seeing how that impacts that specific portfolio. And most times that is put into the context of capital exposure. And all of that is appropriate and it definitely should be done. But again, this is not an independent risk. This has implications in other areas of our institution. So again, from an awareness standpoint, let's just kind of talk about a couple of those other areas and how credit risk can potentially have implications. Now, the first one, quite frankly, is very obvious, and it's not necessarily complex modeling, but it is a calculation none the same, and it bears exploring a little bit for this topic, and that's CECL, your reserve calculation. The uncertainty of the future, all those different things that Matt was talking about earlier on, is exactly what CECL was supposed to and is supposed to try to address, right? It's not supposed to be looking back. It is supposed to be forward looking. And when we think about this particular model, and we all went through just a couple of years ago, kind of putting this in place, the main things that as we look at uncertainty, there's three things that we kind of think about. Number one is the Q factors. So the Q factors have economic, number one out of all the Q factors, I think, per the OCC listing of standard factors, is economic, right? So we take a look at what kind of things we're looking at there. Now, maybe a lot of you had gone through and reevaluated what you're using for forward-looking economic items. And it's so that way you don't have lagging indicators or things that are going to be indicating what had happened recently. One of the ones that I wanted to highlight is the leading economic index. This pulls together a lot of information into a single index that can help us try to say that this is truly a forward-looking economic measure. And what is it? Well, this is actually published by the Conference Board. And it takes a look at several different things, such as average weekly hours of manufacturing, new orders, building permits for new housing, et cetera. Again, this is going to be a national level. It's not going to be specific to your region, but it's pulling together a lot of things that would take you considerable time to try to pull together. So this potentially, if you're thinking about your Q factors and if there's a way of enhancing what you have, this may be a good one for you to consider. The second thing when we think about the CECL tool is the stress testing. Now, interest rate risk always had stress tests. The shocks 100 up to 400 up, same direction down. What does that do? Liquidity stress testing. You have your moderate, your severe, and your crisis type of situation. CECL's pretty much, or the reserve is going to be pretty much looked at the same way from examiners. It's not a requirement yet, but with uncertainty, that question can arise to say, what does that mean as far as how much would you have to change your reserve level if loss rates changed? Or if your recovery couldn't happen, kind of that isolation I was talking about, but they're kind of wondering how that's going to affect the potential calculation when it comes to CECL. Now, within our ALM driver tool, we actually have that already built in. We model it the same way we do your liquidity stress testing, moderate, severe, crisis situation. But really what that's just doing is it's amping up the loss rate. And our model, by the way, is probability of default approach. So it ties right into this theory. But it's amping up your loss rates or reducing your recovery rates. And just with a click of the button, you can actually see how much your reserve would need to change. And then you can even drill down to say, well, what if that happened more in the ag sector? Or what if that happened more in our consumer book? So it is an important kind of aspect of modeling the credit risk and how it has the implications on that CECL calculation. And then finally, when it comes to CECL, of course, there is the unfunded. That is an area that is kind of the gray area. But quite frankly, that is an area when we talk to banks as far as their examinations or their third-party validations that they're having now done on their CECL programs, which, by the way, is an area of focus. The unfunded commitment area is one that is being looked at, probably next to second highest next to the Q factors, excuse me. So what does it mean? Of course, remember you have if it's unconditionally cancelable, that is something that you don't have to include in your CECL calculation. But the other aspect, which is the draw potential, and if they were to draw, what extent you may have for a level of draw, those two assumptions are being looked at a little bit more. So I would encourage you, as you take a look from a credit risk standpoint, as we're talking about it, how does that kind of, what assumptions are we using in our CECL calculation? Should we be just making ourselves aware of it? Doesn't mean you need to change it, but just have an awareness, because from an exam standpoint, they'll want to make sure you've got your hands around that as well. Now, another area we talk about how risk permeates different areas. Liquidity risk testing is something that we all think of as deposits heading out the door, right? What if we have a certain amount of runoff within our CDs over a period of time, or our non-maturity deposits? That's the main stress. And oftentimes with liquidity stress testing, you'll also potentially stress your sources, right? But where does credit risk potentially come into this? So really, there is absolutely liquidity risk associated with credit risk, right? So someone stops paying on their loan, that's a cash flow issue as well. You had forecasted that type of income going forward, and potentially those funds becoming available as those payments were coming in. So there is absolutely that direct connection between credit risk and liquidity risk. Now, the two areas that we would want to touch on, of course, is prepayment. Now, this is a very common one that you need to be aware of. It's associated with the lending book, and with liquidity risk, slowing of payments is certainly going to affect your liquidity availability. So does your stress testing for liquidity incorporate potentially that exposure of prepayments slowing down? So that's kind of an area to be aware of from that type of testing. The other is defaults. That's the big change in cash flow. And so the question would be, when we take a look at our liquidity stress testing, as we look at our assumptions in doing that, does that incorporate that area as well of defaults? Now, we have, over the course of the last several years, we've had the fortune of having some of our customers invite us into some of the examiner conversations that have been happening at their banks. We're very privileged by that, and definitely allows us to kind of hear firsthand a lot of the things that they're talking about. And I wanted to share with you some of the comments that we've been hearing from examiners on the liquidity side, and it ties into kind of the credit risk assumptions built within there. So one of the things with some liquidity stress testing events is the ability to slow down your lending. That is a liquidity relief from that standpoint. You don't have the growth or continue funding of new loans. It can help with that liquidity. So the questions that has come up from that standpoint has been the level of reduction, right? So if you do incorporate that into your liquidity stress test, just want to make sure that you're taking a look at how much does that dial back your lending from a relief standpoint? Or are you assuming that you're just going to continue to lend at the pace you do, even though you're going through a liquidity stress situation? So just kind of take a look at the origination numbers that means. The other one is draw levels, right? So if you have a lot of lines of credit, they're going to say, well, within your liquidity stress test, are you assuming that you have a certain level of draw, kind of like that conversation that topic we just talked about with CECL, right? That should be part of your liquidity risk assessment that's tied into the credit capabilities. The other ones are a little bit more generic. The speed of the stress is something that seems to be coming up a lot. What if that stress doesn't happen within 12 months, which is kind of a standard window for a liquidity stress test? What if it all of a sudden happens within 1 month? Right after the Silicon Valley Bank situation, we had an examiner say, well, what if it happens all tomorrow, a crisis situation? Of course, you can imagine what happens with bank results with that. But and that kind of drives us into the last topic that we've been hearing from examiners. And of course, that is I want to see what's going to create a failure for the bank. So as you think about a liquidity risk scenario, you can certainly just say, well, what if everybody walks out the door tomorrow? That'll create a bank problem that you can't recover from. But the other thing would be to kind of create a reasonable mix of people departing, but also making sure you're incorporating a lot of that credit side, which is really ramping up the draw rates to a high level for those lines of credit to be able to reflect that as well. So just a couple thoughts as far as how credit risk can tie into that liquidity risk testing that you do from that standpoint. And the third area, we've talked about a few areas, but interest rate risk certainly has credit component to it. Now, some models out there, and I'd say a lot of models out there really don't bring a credit factor involved in the assessment process. So for your EVE or your economic value of equity measure, you're saying this is the value of my loans. What often happens is that a model is going to take a look at the interest rate and take a look at the prevailing market rate and say, you've got a good deal or it's a high value or not. But as you know, that is also dependent upon the credit quality, right? So you can have something that's 1% higher than the market, but if it's C paper, that should not be valued at the same level as an A paper loan. So some models incorporate that, some models don't. The ALM driver tool does. And then the other aspect is within the interest rate risk when it comes to the credit side is, again, getting back to that prepayments, what happens in a rising rate environment. You have certainly implications as far as potential prepayments slowing down. That's going to change your interest rate risk. You'll just want to make sure that when you take a look at your settings for interest rate risk, prepayments are fluctuating when you look at the different shock levels. So the last one I had on here is default. And here's where I want it to be very cautious. You may say, well, if interest rates rise 4%, I think we're going to have some default issues. But you need to be cautious. And this is where I don't want to get too deep into the modeling. But remember, your models for interest rate risk, assuming balances don't change. So what happens is you up your default levels. It's going to also then assume that you're going to be getting a lot more originations to replace them. So the bottom line with this, with a lot of these areas that I'm talking about, is lean on your provider, right? You have a partner with expertise, and they're able to kind of talk about these pros and cons of the assumptions, right? The assumptions need to be bank specific, but you should be able to have conversations to kind of process through what that means from a modeling environment. Now, I mentioned the realism of being able to do all these things, right? So from that standpoint, you can say, well, great. We've got all these different things. I got to create 20 different scenarios. I got to stress test things 20 different ways. I don't have time for this. And, and besides, we're going to be kind of buried and it's not going to have some meaningful information. Again, models have come a long way recently. And one of the things that actually is something that should be done periodically is what's called a sensitivity analysis. A sensitivity analysis allows you to do a very refined look at some of the risks, such as credit risk, and how it relates to interest rate risk. And really what you're doing is you're taking one component and you're tweaking it to see how much that changes your interest rate risk number. That's what a sensitivity analysis does. Now, within the ALM driver tool, that actually is something that we have as a built-in calculator. So, and this is just kind of help you visualize maybe what your model can do, but this is how we present it. And so as you can see on the left-hand side, we have the current assumptions, and this is a blending, by the way, of all assumptions into a single factor for prepayment, that's CPR, cert default rate, CDR, and decay, which is in the bottom left, and beta. And what you can do is you can change these individual factors. And then what that does is then you can actually see the results. Here we're actually looking at income sensitivity. You can also do this for valuation or EVE. But it is something that I think can drive a lot of really good insight as far as, well, how much, if prepays start to slow down or to pick up, how much is that going to be affecting our interest rate risk? Again, looking at that credit aspect to the overall risk of the bank. So I would encourage you, if you haven't done a sensitivity analysis, it is recommended that it's done on an annual basis. And if interest rates and your settings and your environment hasn't changed a whole lot, an annual basis could be fine. If we go through a dramatic change of rates rising or rates falling, you may want to increase the frequency of that as well. But this is something, and again, you want to do these in isolation. You don't want to change 3 of these at the same time, because then you don't exactly know what's influencing what. So definitely a tool. And one last thing that I'd comment about this, when you're stressing it, you should see results as far as policy limits. I don't have it on our screenshot here, but that isn't, if I scroll down, it would be another table or a chart that would actually show how much in the shocks did this change. And what we would recommend for conversations with an ALCO is to stress this to the point of maybe incurring an inflection where you become now asset sensitive versus liability sensitive. It would take this much of a change in default rates for all of a sudden us to switch. Or it would take this much in our prepayment speed to change for us to now be up against our policy limits where currently we're not. So those are great points to kind of take a look at and be aware of, and really helps drive home what assumption settings are about with your ALCO. So we talked from a credit risk standpoint. We talked about how you look at it in an individual basis within your portfolio stress testing. We talked about how it affects a lot of other, credit risk can affect a lot of other areas of your risk management process. And we just wanted to kind of take a moment to be aware of that picture. Now, that's that aspect of credit risk. But there was something else that I wanted to take a few minutes on here to talk about, and that was when Matt was going through his section about the dynamic environment. One of the things that he mentioned was strategic ALM, right? And oftentimes I get the question, well, what does that exactly mean? It sounds great, do strategic ALM, and that'll make your bank, perform a lot better. And you think, well, we are doing ALM and we do think strategically. So what is this trying to drive towards? And I want to summarize this basically in kind of three key points. Number one, strategic ALM, and that's, by the way, it's kind of the converse of that is traditional ALM versus strategic ALM. The first one is this traditional ALM, of course, is regulatory focused, right? You've got all these rules that you're trying to follow to make sure that you are doing the stress test from a regulatory standpoint appropriately. And that has a lot of great insights to it. It'll tell you, numerous things, but it certainly drives towards the information that helps you kind of watch for the rocks, right? As you're going on your course, you're watching for those rocks so you don't wind up on them as you make your decisions. But strategic ALM is really more about that dynamic environment. So, when we talked about those changes that potentially are happening out there in the world, how does that potentially influence you? I want to kind of bring up an example to kind of talk about how real world this is and how strategic ALM could have helped a lot of banks earlier on in the 2021 timeframe. So when everybody was running their ALM models at the end of 2021, they were saying, okay, well, if rates go up quickly, 400 basis points, what's going to be happening to our income? And the model said that your spread is going to improve significantly, right? Loans are going to be going up quick. Deposits, because there's a lot of non-maturity deposits, they're going to be going up slow because our reaction is going to be slow, and therefore we're going to get that improved spread. Well, in reality, that didn't happen quite like that. As a matter of fact, when I was in an ALCO meeting and one of the ALCO members said, well, I remember back when rates were really low, if rates went up, we were going to be making a lot of money. We're not making a lot of money here. So what happened? Did the models not accurately present the situation? Well, they did for the rules that you were following, right? So what did actually happen on the funding side? Well, on the funding side, as we all saw, everybody didn't sit in those savings accounts with that beta that was slowly going up, right? The model had to assume it. The regulatory traditional ALM says, assume static balances, assume everything stays the way they are. But in the dynamic environment, you had an interest rate risk that was caused by the customer behavior. And so not only did rates jump up very quickly on you from a cost of funds from that standpoint, but the nature of those funds, the profile of those funds changed a lot. It went from non-maturity deposits with a long life to very short time deposits that you only have for a short period of time. Now, is that a glaring flaw? No, it is. The regulatory reports do what they do. And in reality, in a dynamic environment, you didn't lose the money. It got reallocated into something else. And if rates come down, there can be an expectation that that money can be coming back from those time deposits back into non-maturity deposits. So it's not a glaring hole. But from a modeling standpoint, it certainly caught people off guard when they were expecting a nice margin improvement or more of a sizable margin improvement than what actually occurred. So dynamic modeling or strategic modeling can get at that. Okay, rates are going up this. Is there any other things that we should potentially be considering as far as our customer behavior that would help us understand our overall risk? The next thing is the short-term versus long-term. As you all know, the net interest income within interest rate risk models, at least for ALM, is focused on what is the 12-month horizon, what is a 24-month horizon. And realistically, that's pretty much what they can handle. I know the examiners at one time were talking about wanting to see an income assessment of a 60-month horizon. Well, as you know, with budgeting, it's very difficult to try to get your hands around that level of outlook, right? It's hard enough to predict income here in the next 12 months, let alone trying to think what income is going to be in 5 years. But it's very short-term focused. Where strategic ALM, you're really talking about more of your strategic plan. Where are you going? What are you going to try to accomplish with this modeling, right? So it doesn't have to be the 12-month mark. Maybe we can say, well, we're going to run an ALM model and we're going to try to get towards that lending position that we really want to get to and that funding position that we want to get to. Let's run it through the model and see how our risk profile changes for that. And should we evaluate how we fund those differently? That's more strategic ALM. And then the last part here is mitigation versus optimization. We at Bankers Bank have been going through some discussions here about AI. And if you've gone through some of those discussions, it's just amazing as far as what AI can accomplish. It's been around for a while, but the real capability of being able to drive insights, et cetera, has increased exponentially. And it's almost crazy to think about where it's going to be in 2 years or next year from now. The same thing is happening within models. So there are providers out there that are investing in the models, wanting to bring insights to help understand risk, but also not just to mitigate the risk. What do we need to do to kind of lower a risk level? But if we have a certain appetite or a tolerance for certain risk levels, could we put that into a tool? And then could that help us understand how we go about funding or how we go about changing the profile of our investment portfolio? And that's optimization. And if you haven't looked out there at models to see what's coming, take a look. This is a game changer from the standpoint of institutions utilizing technology to be able to really drive the results more so than just managing loss. And that's, or managing risk, excuse me. So that strategic ALM is starting to use the tools to a greater extent. And again, we get into that comment of, do I have time for all this? I was going to mention, I did want to mention, because sometimes you think about, do I have time for this? Is it hard? This is the ALM driver tool. Again, just kind of give you a flavor of how things are changing. The ability to just go to specific points and say, I want to change X, and then simulate the results and see what happens. And I want to change Y, change the results, simulate and see what happens. And tools nowadays can basically come back and, what 6% loan growth, what's happening with our income or our margin? Or another simulation I did 3 minutes after that is, what if we have to borrow $10 million to help with that loan growth? How much is that going to change my net interest income? How's that going to change my margin? Right? So the tools out there, and this is just ours, but tools out there are much more dynamic than they have been in the past. And so again, you want to make sure that you're leveraging your provider and partnering with them to help you. If you don't have the time, they're experts in this. They can certainly help you out. We talk to banks all the time and they give us a scenario, we run it, and then we talk it through with them. And they can actually see the results because they can log in and see what we're doing as well. So again, I'd definitely encourage you to take a look at that and see how it can enhance your bank. So we talked about a lot from a modeling standpoint, high level with credit risk and strategic modeling. And I just tossed out a couple questions here as far as how you engage with your current provider. What is, can you tell me how credit risk is coming into play with my liquidity stress testing? Can you tell me where credit risk is coming in my valuation process? Is that being incorporated or not? And then again, I would encourage that sensitivity assessment, just because that is a really good way to get your hands around a lot of information quickly. And then talking about how to work together, how to actually get more value out of the model that you're already paying for, to get better insights and potentially incorporate some of the strategic things you're thinking about into that process. So again, I love modeling. I can spend all day talking about it, and would encourage you to, again, leverage your partner like ourselves or your current partner and get that insight for you as well. So with that, I'm going to turn it back over to Mr. Paxton to see what kind of questions potentially have come in on either of our topics that we addressed today. David?
Thanks, Jim. So let's look and see here on our chat what came in today for questions. So let me look and see. Actually, let's just do these in the order of presentation. So Matt Ladio, where do you see current market pricing, or where are you seeing current market pricing?
Yeah, good question. Again, we're in 6 states, so I'm going to do a general wider range here, but we're seeing deals for the most part, and again, the ones that we see fall anywhere from that 675 range to the 625 range, depending on where the bank is, depending on the deal size, depending on who you're talking to. I've seen deals, in the 7s and a little bit higher, and I've seen deals and heard of deals in that high 5s and low 6s. And again, depending on where you are with deposits, maybe a 6 1/8 works for you. Maybe you need 7 1/8. So, but I would say what we're seeing and kind of what we're hearing, depending on LTV, debt service coverage, all the good stuff that goes into it. The top end on a 5-year is about 675, and you know, kind of 6.25 on the bottom end. So
Okay. And then we have more questions, but I'll just get to one more here since we're getting into 5 minutes left. Jim, you mentioned capturing credit risk when valuing assets or loans. What measures are you using?
Yeah, so from the standpoint of, getting that credit information into your model, that's going to be reliant on your core. And most models out there should be able to handle either on the consumer side, something like a FICO score, or more likely, more of your internal credit rating score. Now that's going to, require kind of just a conversation up front to say, well, your credit rating of 8, what does that mean, right? So the model will have to be kind of told what that means, but it certainly should be able to handle that. But we've also had conversation with banks that say, I don't really know if I'm all that confident in that data, in some of the data, or maybe we've been only capturing that data in our core for the last 3 years. And so a lot of the information in our core doesn't have that. Is that going to be a problem? And again, with models nowadays, that's typically not the case. With the ALM driver tool, what we do is we can instruct the model to assume kind of a certain, if a credit score is not presented, whether it's internal credit score or FICO, if one's not present, what has been the general credit quality of the loans in those categories? And then, as you populate more information into your core, that assumption is going to become less and less and less over time. So it is bank specific, but sometimes you have to fill in the blanks a little bit to be able to incorporate it.
Yeah, good questions. Well, it's been a pleasure being your host today, and thanks for joining us. We hope that you gained some useful knowledge about navigating commercial risk. Bankers Bank can offer you some professional assistance with handling risk through our risk management solutions division. And we're eager to help community banks because the stronger you are, then the stronger your communities are, and we're here to help. Make sure to take the survey, as your replies will help us create our next quarterly webinar. We just want to make sure we're delivering content that's valuable to each of you in your markets, and we can bring in some things that are insightful and meaningful. I'll look for a recording of this webinar in your email, which will go out soon. I want to thank everyone for joining us again and hope you have a great day.
thanks, David.
Thank you, everybody.
Thanks, everybody.